Welcome back to the channel, everyone. Today I want to talk about whether institutions are a threat to the AMC squeeze. Do institutions actually hold over 50% of the float? And is this a bad thing, or is this actually a good thing? So stay tuned and let's make some money. But before I dive into the video, again, I want to hold another moment's silence for what's currently going on over in Ukraine at the moment. As I've said previously, I'm not going to sit here in silence during the video for an entire minute, but I would encourage you to pause the video and take a moment's silence. But now I want to dive straight in with the key information. So, Blue Ice and Lou have recently been tweeting about the AMC institutional ownership. Blue Ice tweeted saying, "I recently called my broker. It's a well-respected shop in New York and asked him a favour, which is to look at the percentage of institutional holding for AMC. His broker called back and said, Blue Ice or Bill, it looks like it's about 47 to 52%. He got quiet and I said, what? He said, unless it's a mega cap or a blue chip, I don't think I've ever seen this. And then he said our retail holdings here are 21 million shares, private customers who asked us to buy. So whatever the percentage is, we no longer hold 80% of the float. Say what you want, but as we have said, this is a dangerous play for many reasons. Question is, where did these institutions get these shares from? Blue Ice then said, so it seems based on the video I posted, institutions own around 54% of AMC. And as Lou and I have been saying, we do not own 80% of the float anymore. Well, it looks like we don't. Many people need to rethink their numbers, and the question becomes, did the community that claims they are holding sell shares in AMC, or did the amount of synthetics grow? Only time will tell. Now, the first thing that I thought was unusual about all of this was a broker thinking that 47 to 52% institutional ownership is unusual for a stock. I've seen many small cap stocks that have over 90% institutional ownership, and I've also seen many small cap stocks that have 5 or 10% institutional ownership. So I don't really think 47 to 52% ownership is very unusual whatsoever. It's middle of the road. And I also think that this specific employee is talking about the institutional ownership of shares held by this specific shop. Maybe this institution holds 21 million shares on behalf of retail investors and another 21 million shares on behalf of institutions, and therefore the institutional ownership at this specific shop is around 47 to 52%. But from looking at Fintel and the recent 13F filings, it's very clear that the recent institutional ownership is 187 million shares, or 36% of the overall float. Now, maybe Blue Ice has got mixed up by adding the 13D and 13G filings on top of the institutional ownership, because there's around 80 or 90 million shares held here, and 187 million shares plus an additional 80 to 90 million shares brings you to 54 or 55% institutional ownership. Now, that would be fair to assume, because here it says 36% excluding the 13D and 13G forms, but technically you don't actually add the 13Ds and 13Gs. If you scroll down to the definition of 13D and 13G filings, we can see that institutions can submit either 13D or 13Gs or a 13F filing. But if they do submit their 13D and 13G filing, they then also have to submit a 13F filing after that, which reports the total value of shares, which may be a different value to the 13D or 13G. This is because the 13D and 13G is a filing for groups of investors, where a 13F is to file the total shares or all of the shares. And therefore, some institutions like BlackRock and Vanguard submit a 13D, a 13G, and a 13F, but you don't actually include these together because the 13F encapsulates all of the shares. And therefore the institutional ownership of the legit float is definitely 36%. Technically it's slightly lower if you include the shorted shares on top of this, because then the total float isn't 513 million shares, it's around 620 million shares, and the institutional ownership will still be around 187 million. Now, this institutional ownership has increased over the last 6 months from around 120 million shares up to 140 million shares, and then finally up to around 180, 190 million shares. So therefore, the institutional ownership of the legit float, notice that I'm specifying the legit float, has actually increased, and therefore retail investors no longer own 80% of the legit flow. But we all know that there is not just 513 million AMC shares floating around, there's tons and tons more due to all the synthetics. And therefore, while we may not own 80% of the legit float, we still more than likely own 450% of the float all in all, and institutions have only increased their holdings from 120 to 180 million shares. Now, 120 to 180 million shares isn't really much of a big jump because obviously we, the retail investors, still hold 2 to 2.5 billion shares when you include all the synthetics. Maybe it's way more, maybe it's way less, because I don't know the exact value of synthetics. But to give credit where credit is due, maybe Blue Ice and Lou do have an inside source, and therefore now in Q1 of 2022, institutional ownership is going to increase again to maybe even as high as 250 million shares. Now I've drawn a bit of a diagram to explain whether this is a good thing or a bad thing. Is it good that institutions hold 180, maybe even 250 million shares and own a larger portion of the shares in issue? Or is that a bad thing? Guys, if you haven't already, be sure to sign up to Moomoo using the link in the description below and make your first deposit to get up to 5 free shares valued up to $3,500 each and a free share of AMC as well. In my opinion, Moomoo is one of the best commission-free trading platforms because it helps you to trade like a pro. Moomoo has over 90 technical indicators and advanced trading tools like stock screeners, for example. Moomoo also has over 2 million clients worldwide. Investment products and services available on the Moomoo app are offered through Futu. Futu does not accept payment for order flow as they make their money from margin interest and from payment fees. The Moomoo platform is also incredibly easy to use. You've got all the latest SEC notices here, you've got the AMC options chain, you've even got the latest AMC position cost distribution, and all of the latest AMC news in this column here. That way it keeps all of the required information in one easy to use platform. Now I think the first question we have to ask ourselves is, do you believe that there are any AMC synthetic shares? If you personally do not believe there is a single AMC synthetic share, this is a bad thing, because it means that AMC retail investors, the apes, have paper-handed their shares and sold some shares directly to the institutions. This means that apes do not own 80% of the total float, including the synthetics, because in this instance, you're believing that there aren't any synthetics, and therefore apes own a smaller percentage of shares outstanding, therefore institutions own more, and can continue lending out these shares. They can also make it really easy for the shorts to cover their shares, as they now hold basically half of the float and could sell all of these shares at really low values in order for the shorts to cover. But I personally do not believe this is the truth, because I believe there are way more than 0 synthetic shares currently in issue for AMC. I personally believe there's at least 2 billion synthetics, leading to a total of around 2.5 billion shares. The log the float data came out recently, which suggests there could be even more synthetic shares than we even thought, maybe even as high as 4 or 5 billion synthetics in total, and I'll talk about that in another video. So let's assume that you do believe there are indeed synthetic shares. The next question we have to ask ourselves is, have any of these shares that are held by AMC retail investors been paper-handed? Maybe the institutions bought an additional 60 million shares, or maybe even an additional 130 million shares after December from us, the AMC apes. Is this a good thing? Well, actually, I believe yes, it potentially is a good thing, because it means that institutions have bought the paper-handed shares, not the shorts. The shorts haven't bought these paper-handed shares to cover their short positions. Actually, institutions have been buying these shares and continuing to go long on these shares and are not allowing the short hedge funds to cover their shorts. On the other hand, if you do not believe that any of the AMC apes have been holding their shares, that means that 0 shares have been paper-handed, and therefore for the institutions to buy even more shares, it means the market makers must have created more synthetic shares and synthetic shorts. Hedge funds have then shorted these shares and sold them directly to these hedge funds. And therefore, if the hedge funds have bought an additional 60 to 130 million more synthetic shares, it means there's tons more synthetics that have been created. And again, this is a good thing because it means there's tons more naked shorts that need to be covered. When AMC squeezes, this is just an additional 60 to 130 million more shorts that must be covered during the short squeeze, which will elevate the price of AMC even higher. Now guys, I also wanted to talk about the AMC chart using the Moomoo platform. Over the last few months, AMC fell to its lows of around $13.40 before bouncing off back to around the $21 region. Obviously, over the last week or so, AMC has been falling along with the wider market down to around $16 per share, but there is a strong area of support between $13.40 and around $16 per share. I personally don't think that AMC will be revisiting that $13 per share area because it ties in nicely with the short interest figures. You can see here in the bottom right hand corner, AMC is currently hitting an all-time high for short interest percentage and also for shares on loan and shares shorted. AMC currently has around 21% short interest with around 107, 108 million shares currently shorted. We can also see that the current borrowing rate on Moomoo is around 4%, which is higher than most other platforms. There's also only around 950,000 shares available to borrow, which is much lower than we've seen in recent weeks, where there was at some times around 10 million shares to borrow. As I spoke about in my Catalysts video the other day, I think all of this is lining up nicely with the 100% utilization to suggest that AMC is just about to go on its next run up. But now I also wanted to talk about the motivation behind some of these institutions and why they're buying more AMC shares. I want to ask the question, are these institutions buying shares in order to try and stop or kill the squeeze and allow other short hedge funds to survive? Personally, I don't think this is the case. An institution's motivation is to make money. Therefore, why would they buy loads of shares and lose tons and tons of money in order to prevent the squeeze? You may say, Tom, they're making tons and tons of money from lending out these shares to short hedge funds and allowing them to short more shares. Surely they're making more money from share lending than they're losing from buying the AMC shares. Now, actually, this isn't the case, as I'm going to show you in a minute. You may also say, Tom, they're going to buy AMC shares and sell them just above where they bought them for to make a small profit. They're going to sell far, far too early. Now, I personally do think that institutions will likely sell sooner than us apes, but I don't think they're going to sell early in order to make like $1 profit on every share. I think these institutions will let the squeeze go ahead and they can make tons and tons of money during the squeeze, but they can still end up selling early and being responsible and safe, low risk and all of that kind of stuff. They won't hold to thousands and thousands or hundreds of thousands of dollars per share, but I don't think they're going to be selling AMC shares at $2 above what they paid for them. So let's look at exactly how much money these institutions have lost so far on their AMC purchases compared to the amount of money that they've made from the AMC share lending. In quarter 2, institutions held 120 million AMC shares. Quarter 3, 140 million, so therefore they added an extra 20 million shares. In quarter 4, 180 million, so they added an extra 40 million shares. In quarter 3, the price of AMC ranged from $28 a share all the way up to $57 a share. So let's assume that these hedge funds or these institutions purchased 20 million AMC shares at the very, very lowest point at $28 a share. Again, in quarter 4, the price of AMC ranged from $20 a share to $46 a share. So again, let's assume they bought the entire 40 million shares at the lowest point at $20 a share. 20 million shares at $28 a share is $560 million. 40 million shares at $20 a share is $800 million, and in total that's $1.36 billion these institutions spent on AMC shares in the second half of the year. $1.36 billion divided by the total 60 million shares that they purchased is an average purchase price of $22 per share at the absolute minimum. Right now, AMC is trading at $17 a share, meaning that their total share value of those 60 million shares is around $1.02 billion, meaning that the institutions so far have lost $340 million on the AMC shares that they've purchased after the June run-up. Now, if we head over to iBorrowDesk, the share lending fee, this red line here, has been 1%. At one singular day here, it did jump to 6%, but every single day it's been at 1% flat. And therefore, 60 million shares times by this average purchase price of $22 a share, multiplied by 1%, is $13 million they've earned from share lending in the last year. Obviously, these shares have only been bought in the second half of the year, therefore you've got to divide it by 2. And therefore, in the second half of the year, they've lost $340 million by holding their AMC shares and only generated $6.5 million in share lending fees. And therefore, these institutions like BlackRock and Vanguard that have bought AMC and are lending out their shares are still down massively because the price of AMC has fallen so drastically. And therefore, the reason why these institutions are holding AMC is because they know it's going to squeeze and they know they are going to be able to sell AMC for more than they bought it for. Now you may say, Tom, that's exactly the point. They're going to make their small amount of money lending out the shares, then they're going to sell AMC as soon as they're in the green and crush the squeeze. But I think you have to remember how many shares these institutions actually hold compared to the amount of shares that we hold and compared to the amount of shares that are currently shorted. We know that institutions hold around 180 million shares, but when you include all of the synthetic shares and the naked shorts, we know there's about 2.5 billion shares total, 2 billion synthetics, which means around 2 billion shorted shares. Therefore, the institutions can sell 180 million shares directly to the shorts very early on during the squeeze in order to try and crush the squeeze, but the shorts need to cover their entire 2 billion shorted shares. 180 million shares is a very small portion of the total 2 billion shorted shares or 2 billion naked shorted shares, and therefore 180 million shares doesn't really make much of a dent in the squeeze. I think it's important to remember that on the 1st of June, Mudrick Capital sold in one singular batch 8.5 million shares. They sold their shares for around $25 to $27 a share, and there was barely a dent because of how many AMC shares were being traded on the 1st and the 2nd of June. There was hundreds of millions of shares that changed hands every single day in the 1st, 2nd and 3rd of June, and therefore 8.5 million shares barely made a single dent. On top of that, we also saw Wanda selling around 44 million shares in the April and May period, which again barely made a dent, and AMC still ran up in June. So in total, the institutions have around 180 million shares of AMC that they could sell during the squeeze. They could sell 180 million shares in one singular block. That would obviously have a massive dent and would cause the price of AMC to drop drastically. But as these hedge funds are still being liquidated, that still leaves around 1.82 billion synthetics that need to be covered after they've bought 180 million shares from the institutions. Again, the institutions could sell these in batches of 10 or 20 million shares. Therefore, they can sell multiple times over during the squeeze in order to try and stop it or to try and confuse us to think that the squeeze is over. But again, I think it's important to remember that this 180 million shares is still a fairly small portion of the total 2 billion synthetics that need to be covered and the total 2 billion synthetics that need to be bought back from us, retail investors. I think it's also important to remember that during the squeeze, when these institutions sell off these 180 million shares, they aren't necessarily going to be selling them directly to the short hedge funds to enable them to cover their shorts. When these institutions list to sell those 180 million shares in the market, they're also going to be purchased by us, retail investors, and they're also going to be purchased by other institutions and other hedge funds that want to buy more AMC during the squeeze. And therefore, even though some institutions like BlackRock and Vanguard have 180 million shares in total to sell, it doesn't necessarily mean that all 180 million shares are going to be purchased by those short hedge funds to cover their shorts. They may also be bought by retail investors like you and I, and other hedge funds that want to profit from the squeeze. Yes, the institutions do have a lot of shares to sell, and it will likely drop the price of AMC quite heavily. AMC may run up to $500 a share during the squeeze and then fall all the way down back to around $200 a share. But all of those shares still need to be covered. All of these institutions still will be being liquidated. And when they are finished being liquidated, all of these shorts will be bought back. And not only will these 180 million shares worth of shorts be bought back, but the full 2 billion synthetics. And therefore, all in all, I don't really think the institutions are much of a threat to the AMC squeeze. Yes, they may plague the squeeze a little bit and may potentially fool some people into thinking the squeeze is over, but overall, in total, 180 million shares is still a very small portion of the total 2 billion synthetic shorts. Guys, be sure to let me know down in the comments below whether you think that institutions are a threat to the AMC squeeze. And as always guys, if you enjoyed this video, be sure to check out some of my others. Alternatively, subscribe to the channel and ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.